In this week's video, we'll review the latest charts and data to help us answer the question, are we on the cusp of another global financial crisis? This is a look at the weekly chart of the S&P 500 1 week ago as of March 28th. If we fast forward, as of the close on Friday, April 4th, you can see we did not hold this line nor this line. Typically, within the context of this trend, a weekly break like that has been followed by additional downside. Tariff announcement came after the close on Wednesday, April 2nd. Maybe hard to believe, but the S&P 500 was up 90 points for the week as of the close on April 2nd. Relative to market expectations, the tariffs were larger than expected. Upper right-hand corner of your screen. Most were anticipating that the effective tariff rate would have gone up by about 10%, so approximately a 1% hit to GDP. But it looks like it's more in the range of 15 to 18%, which is 50 to 60% larger in terms of the impact than what was expected. And since there was no question the announcement was closer to the worst case scenario relative to the best case scenario, not surprisingly, the stock market plunged on Thursday. And that was followed by another page from the worst case scenario playbook. On Friday morning, market participants woke up to this headline: China to impose 34% tariffs on U.S. Larger than expected tariffs, followed by retaliation. For the most part, in one instant, incentives around the globe were shifted significantly. Technical analysis is about identifying shifts in market behavior. Stock market bottoms here, resistance. Stock market bottoms here, it coincides with resistance. This looks different relative to this and this. And as you might imagine, before the tariff announcement, this chart was down here as of Wednesday's close, nowhere near the blue line. Covered this chart last week. Let's look at the updated version here as of the close on April 4th. We do not want to make the assumption that resistance, prior resistance, will act as resistance again. However, it's still a possibility. Seen a lot of significant shifts, so I wouldn't make a bet that this green line holds in the coming weeks. Chart up here is a monthly chart of GLD relative to XLK. The downtrend in gold relative to tech started in 2011, 2012. This looks significantly different relative to anything that we've seen for several years. Google Weekly, this looks significantly different relative to anything that we've seen since the low in November of 2022. The market's drawdown as of Wednesday's close was 7.7%. In 2 trading sessions, it expanded to 17.42%. Hence some of the adjustments, additional incremental adjustments to our portfolios. If the present day chart, upper right hand corner of your screen, starts to morph into something more like this, or this, concerns would increase. We just don't have that at this point. That is reflected in this score here. So we're in Mitigation 1 and have been in Mitigation 1 for several weeks as we've been taking incremental steps to raise cash and reduce risk. This will allow us to reasonably get back to a fully invested position if the secular trend remains in place. And it will also ensure that if the present decline turns into something like a 50% decline here, a 50% decline here, and or a 50% decline here, that we will be in a position to shift to Mitigation 2. All of that hypothetical, of course. We're not making any assumptions about how anything plays out on any time frame. We'll continue to take it day by day. The S&P 500 closed above an upward sloping 250-day moving average in black on Wednesday. Here's the close. Here's the closing value at the end of the week on Friday. Haven't seen a clear breakout in bonds yet. This is IEF back in 2022 here. This was the high of the day on Friday. We closed back in the box here. There's another observable and concerning shift. We have both weekly MACD and PPO closing this week below the zero line. That is different from this point here and different from this point here. And from a probability perspective, rather than being a counter trend move within the context of an existing uptrend, we have now shifted gears from a probability perspective to a weekly downtrend. A lot of good news, bad news charts here. The good news is the secular trend appears to be in place. What we have in the present day isn't radically different from what we've seen in the rearview mirror since, let's say, 2018. It's only April 4th, so the fact that we have a bearish cross here on some of these momentum indicators, we may or may not have that at the end of the month. Nonetheless, all things being equal, that's a concerning look. Having said that, this cross here is occurring well above the zero line, similar to this cross here, and this cross here. And in every instance, the market eventually righted itself and went on to print a higher high. If the chart over here starts to morph into something more like this or this, concerns would increase. And if this starts to morph into something more like this, the dot-com bust bear market, or something more like this, early 2008, again, concerns would increase. This is a mitigation one look at the moment. A lot of these charts are going to have a similar theme. Typically, when you are below the 200-day, the 225-day, and the 250-day moving average, you typically see additional downside. This is a short stay and a bullish look. That's not really the characteristics of a short stay look. Everything that we just said about the prior chart applies to this weekly chart with the 30, 40, and 50-week moving averages. Probably fair to say what's transpired in the last 3 weeks is significantly different relative to what we had in the rearview mirror in 2023 and in 2024. Markets can bounce at any time, and we're not overly concerned with that part of the equation. Still in a region here of possible support, but we also have a little bit of an air pocket look here, which is somewhat concerning. Nasdaq new highs, new lows a week ago on March 28th. If we updated this chart at the end of the session, we would be somewhere down here. This is starting to look a lot more like early 2022 and significantly different relative to this, and this. Doesn't predict anything, it just speaks to probabilities. Helping us keep an open mind about better than expected outcomes over the next few weeks, probably fair to say the present day chart looks better than this look in here in Q1 of 2022. Are the credit markets still holding up extraordinarily well? They are not. BKLN as of the close on April 4th. Bad news, you could definitely see the case for additional downside in the coming days and weeks, but you could also see an area of potential support as well. A flattening out 200-week, thus some reason for concern, and also some reason for some prudent patience. Hence the incremental approach. This is early 2023 here, probably fair to say this looks worse than anything that we've seen in here. We can make the same claim here with the deteriorating look on the weekly cloud, checking all of the bearish boxes. Did the ugly chart of SMH that we covered in last week's video improve? It did not. This is April 4th. The good news would be SCHG relative to VU is still above an upward sloping 200-week moving average. The bad news is we've got white space in here, and even if we held in this area here or here, it would imply potentially additional downside. If you were to look at this chart, upper left-hand corner, this chart here, and the fact that banks lost 10% this week, it's probably fair to say the market's primary concern at the moment is not inflation. These are more deflationary type looks, traditional recession type looks. Given the massive shift in incentives, it's not surprising this chart, and this chart look as they do as of the close on April 4th. As of the close on Wednesday here, SMH was still in this broad trading range. Not the case after the close on Friday. Momentum trying to turn up. Weekly RSI holding 50. Price above an upward sloping 40-week moving average here in blue. This is the look of SMH, a somewhat encouraging try to be patient look on February 19th, 2025. This is the same chart today. Rolling over below the MA. Didn't hold the 50 line here on RSI. This now below zero. This is a weekly chart of SMH. There's some potential good here, and there's also reasons to be concerned. Relative to this chart, concerns started to increase in here. One of the reasons why we've been cutting risk for several weeks now. And between here and here, it's still concerning. That doesn't necessarily imply that value is the place to be. This is SPYV value relative to VU. This is the 200-week moving average here in red. Not particularly encouraging that we lost all of this, and that we now have what looks like a failed breakout. This is the close on Friday right at the 200-week tech relative to the S&P 500. But you don't want to make an assumption that that's going to hold, especially when momentum is getting weak like this. This is weekly TSI down here for XLK. The last time we had a weekly close like this, Q1 of 2022. Q1 of 2022. Big shift on the chart of JNK, a reflection of the credit markets. This is most likely Wednesday's close here, well above an upward sloping 200-week moving average. This is Friday's close. Intermediate term concerns. This still looks good from a longer term perspective, as does this. Having said that, if we came back to this area here, it would imply additional weakness. If we were to look at this chart closely, I believe this is the first time these high-low close bars have closed below this blue line, which is a subtle and negative shift. We've had intraday moves below the blue line, but we've never had a close. And within the context of these moving averages in here, this tight rolling over look, unless something improves, which it can, it did here, and it did here, the chart in front of us, not a lot to get excited about. You can pause your video player here, but when LQD starts to underperform IEF and is below the 30-week moving average as we are today, and maybe more importantly, weekly MACD has crossed below zero. Typically when that happens in the rearview mirror, those are not bullish periods for the market. A lot of the weekly momentum indicators, this below zero looks different from this. In this instance, when we dropped below zero, we held at or near an upward sloping 200-week moving average. We do not want to make an assumption that that's going to happen, hence mitigation 1. If this type of look here morphs into something like this where we do not hold those important levels, or this, we'll have to consider additional defensive action. Not unusual to have a battle in this area here. We're not even making an assumption that we're going to come down into this area. We don't know that. I talked about this chart last week. Compare the look here in January of 2022 to the look in the present day. Not particularly encouraging, maybe with one exception. It's such a sharp waterfall decline. A bounce wouldn't be shocking. And it's also possible in this environment, if the fundamentals shifted significantly, that it could be a waterfall type decline followed by a V. There's a lot of ifs in there. Probably better off just taking it day by day. We'll learn something relative to what price action does in this region here. This is 2009 for the Nasdaq weekly, lower left-hand corner of your screen. This is Friday afternoon around 2 p.m. Eastern Time. Nasdaq weekly for the first time in quite some time checking multiple bearish boxes on the weekly cloud. This could potentially act as support here. And from a good news perspective, the green span, blue and red, all still above the cloud. Until something improves, this daily look on the Nasdaq is concerning. Price was up in this area intra-week, so we were holding this area of short-term support. We did not do that on Thursday and Friday. On Wednesday, the Nasdaq was up for the week 1.61%. It finished down 8.33%. We had a turnaround from approximately plus 2% to down 8% in 2 sessions. As we've noted in recent weeks, typically when you lose the 200-day moving average, it's followed by additional downside. Not always, not always, not always. Those are short stays and they tend to be bullish. This is not a short stay look. This is the zoomed in version here. Also noteworthy, the slope of the 200-day moving average here starting to roll over. Chart has some potential reference points here with the retracements based on this low and this low. When things have gotten ugly in the current secular trend, the market has tended to make a stand at or near these moving averages. You can see they come together here. The lower blue trend line, the 225-week moving average in brown, is approximately 12.3% below Friday's close on April 4th. Now, experience says we don't want to make any assumptions that we're coming down into this area. We just want to know what reference points we have close by that can help us make those incremental decisions. These moving averages were potential support in the rearview mirror. They're not particularly helpful to us anymore relative to making incremental decisions. They've already been helpful, and they helped us take money off the table weeks ago. Now we need new reference points to make similar decisions. All of that represents a small sample of the strategies and tactics that we'll be using in the coming weeks. This look here is similar to the point here in 2022, similar to this point here in Q4 of 2018, and similar to this point here very, very early in 2016. In the historical cases, there was additional downside, and additional downside. Simply speaking to probabilities in the present day, even if we just went back to this line here that acted as resistance, that would imply additional downside. None of it a prediction in any shape, form, or fashion. NYSE new lows as of Thursday's close. Point of the exercise, as of Thursday's close. This looks significantly different from what we've seen recently. We even exceeded this high. And as of Thursday's close, this was starting to look a lot more like this back in January of 2022. Bad news, Dow Jones Industrial Average broke this area of potential support. The good news is here's another area of potential support. But the bad news would be even if this area were to hold, that would imply additional downside. Chart of the Dow Jones Composite that we said was concerning last week on March 28th. Thus far, we're not getting a bounce here at the top of the box. Not a particularly encouraging look. Bounces, they can happen at any time. The last 2 times the Dow Jones Composite came down near an upward sloping 200-week moving average, it made a stand at or near that upward sloping 200-week moving average. We are approaching it again. There's something slightly different here. See how this is flattening out? It's not really what we had here. That's clearly still sloping upward. That's still clearly sloping upward. This is telling you the probability of breaking this line this time is probably higher than it was here and here. Doesn't mean it's going to break. The last time this happened, it was concerning. Somewhat of a mixed bag in the rearview mirror because in these cases, most of the pain was already in the rearview mirror. But it's probably fair to say this and this, they do look a lot like early 2022. This is the Dow relative to the Nasdaq. It's a weekly cloud as of 2:52 p.m. Eastern Time on April 4th. Checking all of the bullish boxes as we were in January of 2022. At a minimum, this is telling us that the prior trend that was in place on this chart, dating back to very, very early 2023, late 2022, the current leg of the bull market, From a probability perspective, it looks like that trend is trying to flip, similar to this flip here in 2022. Let's go to the upper center portion of the screen. You can see we had a similar look on December 7th, 2018. And you're looking at the green span, the blue span, the red span price, and the cloud, and the fact that the cloud is flipped from red to green. And yes, this is green down here. From this point here, the S&P 500 dropped an additional 10.71% between December 7th and December 24th. The Nasdaq lost an additional 11.14%. Each case is unique. Got the Nasdaq spiking very, very high, which again implies we could get a bounce. But if you look at this chart, study it, it also tells us it's possible when you hit this level, this level, this level, etc. At least in historical cases, in many cases, there was still additional downside and pain to come. We can make a similar read here when we look at the 1-month VIX intraday here on Friday relative to the 3-month VIX. This area of support did not hold. This is 2021, this is 2024, this is 2025. Again, somewhat of a mixed bag. That's the bad news. The good news would be, in the past, we did hold here and here, simply providing a reference point in this area here, again, implying if you were going to test that additional downside. In this region here, there's a lot of reasons to keep an open mind about the NYSE composite trying to make a stand somewhere near that upward sloping 200-week moving average. A lot of incremental and negative shifts in market breadth. It is probably fair to say that the present day looks a lot more like the periods in history annotated in red relative to those annotated in blue. For the full week, the S&P 1500 index had a 1-week rate of change of negative 9.09% down here. That is extremely rare. One time was in Q4 of 2008, not a particularly bullish time. There was a lot of additional downside. Admittedly, this is a different context. If you look at the market, this is probably a better match. Again, when you hit the blue line right here, there was additional downside in the COVID case. That was the bad news. The good news was it was a waterfall decline, and it was relatively quickly retraced. Historically, when RSI on this chart gets down this low, typically some good things are going to happen. So that helps us keep an open mind about better than expected outcomes. This is a zoomed in look of the S&P 500. Market held here in October 2022. It held here in November of 2023, late October 2023. We're back down to this same line and near the retracements here relative to this A to B move. These are simply reference points. When momentum is really strong and it's a waterfall type decline, don't want to place too much emphasis on areas of potential support, because until proven otherwise, they can just be distractions. They're meaningful if price tells you they're meaningful. That may or may not happen. Got to the blue line, the decline ended. Got to the blue line, the decline was ending. The good news is the blue line's not that far away. The bad news is even if it held, it implies additional pain. Moving average here, similar to this look here as well, and similar to this look here. Having said that, stock market did just fine walking forward from Christmas Eve of 2018 into 2019. It's a discernible shift. We also have a failed breakout look relative to this level here. I've been showing this chart here for several weeks. The areas of potential resistance on a weekly basis were broken in 2 trading sessions. You can make an argument that this point here looks similar to this region in here and similar to this region in here. We also have a discernible shift on the weekly cloud. This is as of the close. We are checking all of the bullish boxes, not by a wide margin, but they're being checked. Blue is above red, price is above red. That's green in this cloud here. Price is above the cloud, and the green span is above price. The longer it stays that way, the more concerning it becomes. There's no question this looks significantly different relative to everything that we had going back to this point in 2023. Minimum volatility reversed relative to the market here. It reversed relative to the market here. It did not do so this week, at least on a closing basis. Also discernibly different. Slope of the 200 week, slope of the 200 week. This has a flattening out, turning up type look, telling us to keep an open mind about a successful breakout attempt. Conversely, we would learn something if the breakout fails immediately and we drop back below the 200-week moving average. This looks discernibly different relative to the trend in the rearview mirror. Similar situation here in late 2021, early 2022, and a similar break of a trend line here in Q4 of 2018. None of these charts are perfect or powerful in their own right, but within the context of the weight of the evidence, they are useful. This is utilities relative to the S&P 500 XLU relative to SPY. Just a few short sessions ago, high yield relative to 3 to 7 year treasuries really didn't look all that bad. That is not the case on Friday, April 4th. And it's also not a good look when you're saying it is similar to the early stages of the COVID waterfall decline. A lot of discernible shifts, a lot of concerning looks. There were a lot of discernible shifts and a lot of concerning looks here, 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 and in here. And in each case, the market made a stand at or near the upward sloping moving averages, and the secular trend remained in place. Very similar theme back here in the 1950s during the secular bull market. That did not happen in the period of secular stagnation, nor did it happen in this period of secular stagnation, where the stock market, for the most part, went absolutely positively nowhere, where the stock market, for the most part, went absolutely positively nowhere. This, and this also look discernibly different from this and this. And all of that can help us make a decision at some point. Should we stay in mitigation 1 because we believe eventually the market's going to right itself and go on and print a higher high? Or will it be prudent to shift into mitigation 2? And since the way you handle this here is significantly different relative to the way you handle this here, we all know it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.